Hi, I'm Holly Thomas, Certified Financial Planner, and welcome to Stocks and Bonds 101. You might have been sent here because you've never invested before, or perhaps you've invested but kind of vicariously through your partner or spouse, and due to some life circumstances, it's now on your shoulders, or at least something you're interested in learning more about. Today, I'm going to talk to you very briefly about what is the difference between a stock and a bond and why should you care. So let's begin by assuming that you want to start a business. Many people at different phases of their life have thought about having a business. And let's say you have an idea for a great little shop you want to own of some kind. And it's such a great idea that you know that you could immediately be successful if you opened 1,000 of these shops at one time, and you need $100,000 for each shop. So 100,000 times 1,000 is $100 million that you need to start this great business venture. Well, what are your options if you don't have $100 million in the bank? Well, you could enlist investors to invest in your business, or you could borrow $100 million and get a bunch of people to lend you the money. Well, that's the difference between a stock and a bond. If you're going to have investors, you're going to give up ownership. You're going to issue stock. If you're going to have lenders, then you're going to issue bonds or debt. So flipping the table around, if you are the investor in ownership, you are a stockholder. But if you are a lender, then you are a bondholder. So what do you get as a stockholder and as a bondholder? Well, as a stockholder, if the business is successful, you'll get appreciation in the value of the business. Not appreciation like, oh, thank you so much for investing, but appreciation in terms of growth in the value of the company. So the business owner believes that this is going to be a great idea. It's going to be highly successful. The value of the business should grow to maybe $1 billion one day. All the investors will participate in that appreciation. Along the way, when the business becomes profitable, or rather, if the business becomes profitable, some of those profits will be paid out to the stockholders in the form of dividends. So as a stockholder, you'll receive dividends. So when you're investing, your expectation with stocks is to get some dividends and some capital appreciation. But as you probably well know, neither of those two things is guaranteed. It can be very risky, and you may get no dividends, no capital appreciation. You could lose your entire investment completely when you invest in stocks. Now let's go to if you're the bondholder. When you lend a company or a government money, which is what you're doing as a bondholder, they're obligated to pay you interest unless it's a zero coupon bond, which is a fancy kind of bond we'll save for another video. And they're obligated to pay you back on a maturity date. So bonds have a maturity date, a date where you know you will get your money back unless the government or the company defaults. And we'll talk about that in just a moment. So contrast that to a stockholder who has no maturity date, no guarantee of ever getting the money back. With a bondholder, you have this date in mind that you know you're going to get your money back. So that's why bonds are considered, in general, safer than stocks. And they are also more protected than stocks because if the company should default, go into bankruptcy, the bondholders get paid first and the stockholders get wiped out. So bondholders frequently, even in a default, get some of their principal back. I'm speaking in just very big generalities right now, but I'm trying to give you the idea behind the difference between a stock and a bond. Now, what about expectation of investment return? Well, because bonds pay interest and have a maturity date, you can expect to get less return on bonds because they're generally safer. Stocks, you would expect to get more return over time if you give them time to work, but they're more risky. So the trade-off is, unfortunately, stocks are the only asset class that have been proven to beat inflation over time. So if your money has got to last you a very long time, like 20 or 30 years, most people are going to need some stocks in their portfolio in order to beat inflation over time. Because whatever income you might generate off of bonds now, 20 years from now is probably going to be not much more than lunch money. So that's the ticket, is to have stocks to beat inflation and bonds for safety. And the right combination of those is the most important decision you can make in your portfolio, and for most people is one that should be made with a professional. I'm Holly Thomas. Have a great week.